Okay, so let us start off. Uh, so today, inshallah, we are going. Can you see my screen?
Yes, I can.
Okay. So international dispute resolution. This is what we are going to study today, inshallah. Describe how OACD's mutual assistance procedures map. They work. Discuss the role of arbitration to resolve a tax dispute. Define the right of a UAE investor under the Human Rights Convention. Identify whether inbound UAE investor may have rights under a human rights convention to sue the UAE government over a tax dispute, and then naturally explain why a UAE tax dispute would not be able to be resolved by a taxpayer applying under the EU or UN convention. So, it looks like today entirely we'll be looking into the international aspects of dispute resolution from a UAE investor perspective as well as OECD perspective. So, Organization for Economic Cooperation and Development. Yeah, I think we all know this is the biggest organization. Assistance procedures. If you recall, what exactly were these? We discussed this a little bit. Aya.
I can't recall. Maybe I wasn't in. I actually skipped two lectures, so maybe I wasn't in that lecture.
Okay. So, anyways, MAP basically mutual assistance procedures are whereby the two authorities, ZATCA, FTA, or for that matter, OTA, they would interact. If you can look at this paragraph, MAP procedures, base erosion and profit shifting project, making dispute resolution more effective. There is an action plan number 14 of 2014 that addresses all the manner and the modus operandi of how the procedures are sorted, how these procedures are carried out. MAP article in bilateral DTCs, I mean double tax conventions, they allow designated representatives, the competent authority from the governments, which naturally means FTA, and in other countries' cases, the local authorities. In Pakistan's case, FBR, to sort out the disputes. Usually double taxation. Uh, Now, juridical and economic double taxation, these are some of the things that are going to come. We're going to, inshallah, read what is meant by juridical double taxation, what is economic double taxation, as well as inconsistencies in the interpretation and application of the double tax convention. So, how many people have joined? I think more have joined. So guys, just a word of advice. Please join the course on time. I think Farjad has joined. So, anyways, since most probable occurrences of double taxation are dealt with automatically in bilateral DTCs through tax credit and exemptions. I think we read in the last session two of the predominant methods, which was tax credit and exemption, whereby in case of tax credit, we claim a tax credit for the tax that we already paid in another jurisdiction. But in case of exemption, we simply exclude the income of our foreign permanent establishments, if you recall. So, Parjad, do you recall the two methods? Can you repeat the two ways double taxation relief is provided? Farjad, you're mute. So, anyways, I think Farjad either cannot unmute himself or something. But, anyways, these are the two methods: tax credit and exemption. On the so it on or the determination of taxing rights of the contracting states, meaning which state is going to tax a particular business in a particular country. This can be a major reason for quarrel between the two states. The majority of MAP cases are situations involving the taxation of an individual or entity. Naturally, it both matters, both sides are addressed in a double tax treaty. So in those countries where individual taxation is there, you will, I'm sure, Haya, you might have seen double tax treaties, right? So individual related
Yes.
taxation is also there, as well as
Yes.
company or corporate related taxation is there. MAP article does not compel the competent authority to reach an agreement and resolve their tax disputes, since it obliges them only to use their best endeavor to reach an agreement. So that means under the map they try it, but it is not guaranteed that it through mutual assistance procedure, two of the tax authorities will always arrive at a conclusion. Sometimes competent authorities are unable to reach an agreement, and the reason range from restrictions imposed by the domestic law on tax administration's ability. So various reasons can happen. By a program of force agreement, some conventions include arbitration clauses in the MAP articles, and the MAP's action plan proposed a mandatory and binding arbitration provision. So, yeah, I mean, there can be an arbitration as well, and then the two tax authorities can come to a conclusion. So, let us read in relation to companies. For individuals, the reasons are usually different. MAP claims to cover transfer pricing. So what we are talking about is the juridical persons, basically companies. So transfer pricing related matters will be addressed in while addressing the conflict or dispute. Where associated companies, we call them related parties, particularly in the UAE corporate tax perspective, of a multinational enterprise, M&E group, incurred economic double taxation due to an adjustment to their incomes. So, Haya, have you ever dealt with a transfer pricing scenario, or come across this?
Yes, I did.
Okay, so what usually happens, like if there is an adjustment that is proposed by a tax authority in a
अंडे में
particular
थोड़ा सा गर्म पानी लेके आना
in a particular
पीने के लिए
scenario, what happens
हल्का सा
in
जो
case of
गर्म कर
adjustment? Miss Hina, I think you need to mute.
Can you please come again? I couldn't hear you properly.
So what I was saying was, in a transfer pricing scenario, like what would be a transfer pricing scenario? Like it is a transaction between two parties, right? Two related
Yes,
parties,
between the associated companies. Yeah.
associated companies, which are addressed in the UAE corporate law as UAE corporate tax law as related parties. The
Yes.
Yeah. So
Yes.
what would be the problem that is created? One related party selling stuff to another related party. What would be the tax
The
fraud or
transaction
uh,
is not at arm's length, and then tax authorities actually intervene.
intervene? So
Yes.
let's say there was a transaction between a UAE company and their related party sitting in Saudi Arabia. Okay. So, and in that transaction, the same thing happened, that the goods that were, the sales transaction that the UAE entity booked was overpriced. Instead of 100 dirham, they charged their related party 300 dirham. Why would they do that? First of all,
And shifting profits.
yes, shifting profits. Why? Because the UAE entity will record a much higher revenue. Why? Because the corporate tax rate in UAE is far less than Saudi Arabia, right? So
Yes. Yes.
this way, Saudi Arabia cost is going to increase. Now, in that scenario, the federal tax authority said to this taxpayer in UAE that you need to do an adjustment in the books, right?
Yes.
It can happen that the FTA will say that, look, you have overstated your revenue. Just for discussion say, actually UAE will never say that. Actually, it is Saudi Arabian authority that is going to say that this expense that you have booked in your books is overstated. This transaction is not at arm's length. So what would Saudi Arabia ask the taxpayer to do in this scenario?
revise it, and it should be on arm's length, and the penalty
Correct.
also will be imposed.
Yes. So a penalty will leave the penalty for the time being, but the
Okay, okay,
adjustment
okay.
for the adjustment, they are going to say reduce your expense. Correct? Because in Saudi
Yes, yes.
Arabia, they booked an expense which was overstated. So the Saudi authority is going to say you have overstated your expenses. So please book a transfer pricing adjustment, reduce your cost. Correct?
Yes.
So if Saudi Arabian company related party is reducing their cost, what would be the effect in the books of the UAE company?
They will reduce their revenue, the sale amount.
Exactly. This is called a corresponding adjustment. Okay.
Yes.
So that's what we are looking in the first bullet point. Transfer pricing is where associate companies of a multinational enterprise group incurred economic double taxation due to an adjustment to their income. Is this point clear to everyone, Hina or Farjad or Pankaj? I think if there's any concern in this point, please ask away. Anyways, then the second aspect that has been mentioned here is the existence of a permanent establishment. So, my question would be to other than Haya, someone can answer this. What exactly is a permanent establishment? Can somebody repeat the concept? Apsar or Pankaj or Hina or Farjad? Anyone? Guys, this is an interactive session. Unless you answer me, I mean, I will assume that you guys understand the meaning of the questions that I'm asking. What is a permanent establishment? Anyone can tell me? Okay. It seems people do not understand the concept of permanent
Shall
establishment.
I?
Yeah, please.
It can be an office, an agent through which the operations are going on, a factory, a warehouse, from which we can establish that there is somebody or a management where the management decision is also taking place. The office, the management decision from where the management decision is taking place, and
Okay.
the person or the company or a branch is doing operations on behalf of the company.
Right. So in layman terms, if we speak, it's a permanent establishment usually refers to taxable presence of a company that is not registered usually at the outset, which is not registered in another country in easier terms, right? Usually it is a fixed place of business. So whenever the concept of permanent establishment comes the in very easy and layman terms, it is the taxable presence through a usually through a fixed place of business or through the presence of a representative, which is usually called a dependent agent in another country where the company has not actually previously registered. And the authorities ask that foreign company to register their permanent establishment in that country. And it usually happens through either a branch or some other manner. So in Saudi Arabia, I think there is a purely a status of permanent establishment without using the word branch has been mentioned actually. So anyways, this is the concept of permanent establishment. And the whole international taxation, one of the biggest areas of disputes is permanent establishment. The amount of one more area that the mutual administrative procedures cover is whether there is a permanent establishment constituted in a country or not. So two tax authorities can quarrel around that or come to a conclusion. And then one more is the amount of profit attributable to a PE. Now that we established that yes, there is a permanent establishment in one of the two in another country of a company incorporated in the first country, then the question comes that how much amount of profit is attributable. That also is a matter to be decided. Then one more aspect, the application of a double tax convention (DTC) withholding tax provisions to income. So, you know, in many countries there is withholding tax. So sometimes these double tax treaties provide a kind of a relief on the double withholding tax. That because these two entities sometimes are group entities or associated enterprises. So under the double tax convention, a relief is provided that you don't have to deduct tax on transactions with your related parties or associated companies. So, Mr. Farjad, are you there? Mr. Farjad, Mr. Pankaj, can you guys hear me? Absar and Kalima. Kalima, you've joined?
Yes, sir. Yes.
Okay. So, see, there will be questions you guys would, you would need to respond to me because otherwise I will not know whether you understand a concept or not. So, please respond when I ask a question. Okay, we're coming to the next UAE policy and procedures. The UAE subscribed to the mutual assistance process because a MAP article is included in most of its bilateral double tax convention. The UAE's MAP guidelines was published by the Ministry of Finance, Department of International Financial Relations on 7 January 2021. So, UAE did become part of the inclusive framework. So, yeah, the guidelines were already printed or published in 2021. Publication was made in order for the UAE to be compliant with the base erosion BEPS project, particularly Action 14, which is on mutual assistance procedures. Final report, which recommends that all countries implementing the BEPS measures must publish guidance applicable to the covered double tax conventions. The published guidance makes the UAE compliant with the MAP procedures. In relation to UAE's position on the arbitration, the background is that the arbitration part of the multilateral instrument, whenever there is a word MLI used or DTC used, sometimes they are used interchangeably. MLI, multilateral instrument, sometimes it refers to that very detailed guidance around, or almost 700 pages long document on double tax model tax convention published by the OECD. So that would be meant by MLI. So there is in the part 4 of the MLI, the arbitration. I think the background is that the arbitration part of the MLI, part 6, provides for a state to choose to apply the part and to notify the depository. So this word depository refers to a particular part of the OECD, department of the OECD, where all countries basically who have agreed to sign a double tax treaty, double tax agreement, once they sign it, they provide it to the depository of the OECD. So let us move to the next part. UAE's notification to the depository. So the UAE's 27 June 2018 notification to the depository, which is part of the OECD, did not contain any reference to Part 6 of the Model Tax Convention MLI. So, at this juncture, the arbitration rules are not available for use by a taxpayer in requiring the UAE competent authority to arrive at a decision with the other competent authority. So apparently this major part is missed out in that notification, where ideally the method of or the modus operandi of how the UAE tax authority is going to literally interact or reach out with another authority. This whole thing in UAE is in its very early stages. Actually, just now, if you really think about it, the first tax year, corporate tax year, for very rare cases, has started from 1 June 2023. And that means the first year, possible first tax year closure would have happened on the 31st May of 2024. And once the tax year closes, after that, 9 months are there for any company to file their corporate tax return. So if you count that time, 31st May 2024, from that point onward, the entire year remains. So June, July, August, September, October, November, and December. So actually, if you really think about it, 9 months are going to complete on the 31st December. So many corporate tax returns will be filed on the 31st December of 2024. So and all of this, differential treatments, all of this is going to arise after December 2024 in the next year. So you can imagine that this whole what we are discussing, it is a great time to read this and get to know it. Why? Because you guys will be ready when this actually starts happening, and you will know that the way to respond to these challenges are through mutual assistance procedures. If there is a client of yours or a company or employer of yours which is cross border, and this type of a situation arises, you will know how to respond to it. So anyways, this was only introduction. UAE is still developing this. With published information confirming the UAE competent authorities having had relatively few cases to deal with by 30th September 2022, and with UAE not having adopted the MLI as mandatory and binding arbitration provisions, the UAE is only the beginning of its path. That's what I said. UAE is only at the beginning of its path to deal with the mutual assistance procedures. So, going forward, inshallah, you are going to learn a little bit more. This leaves an auditor in relatively uncharted waters when determining whether a map dispute is likely to be determined in the company's favor, and if so, how a tax dispute should be reflected in the company's tax provisions or tax expense. But please remember that this case, this type of a situation, a tax dispute, will arise only in case of those companies which have cross-border presence. So if it is everything UAE oriented, then yes, there is also a possibility that without having taxable presence in another country like a permanent establishment, your revenue collection particularly may still be subjected to tax through the withholding tax provisions. Because withholding, in order for tax to be deducted on your revenue transactions, you do not need to have a branch or a permanent establishment in the other country. So, but that even in those scenarios also, double tax agreements will come to your help. I will go to the next point, next topic, arbitration. So, how many people have joined until now? 7. Okay. So, arbitration is a procedure by which a dispute is submitted by agreement of the parties to one or more arbitrators who make a binding decision. So, in choosing arbitration, the parties opt for a private dispute resolution procedure instead of going to court. Naturally, I think you guys uh, in India and Pakistan, because I think entire all the participants of this course are either from India or Pakistan. So in both countries, we have arbitration related matters. Can somebody shed some light on what kind of an arbitration mechanism exists in India or in Pakistan? Saya, would you like to say of how it happens in Pakistan?
We have over here FTA. So there we apply and our issues get resolved over there.
What
We have
is
an
it?
FTA department. FTA,
FTA stands for
Federal Tax Ombudsman.
ombudsman. Okay.
Yeah.
So
So
that's huh.
so there our matters get resolved when such situation arise.
Right. And what happens in India? Is there an arbitration wing there in India for tax matters resolution? Anybody from India who can comment on that? Okay, none. I think it's not there. So anyways, I will go to the next stage. The key point for us to remember is that naturally arbitration is on a table. It's not basically both parties are coming to a deal. Usually tax authorities in this particular scenario it will be tax authorities, but arbitration can happen between the taxpayer and the authorities as well. Anyways, OECD Model Tax Convention. Let's see. Article 25 of the OECD Model Double Tax Convention, where under the map, a person has presented a case to the competent authority of a contracting state. So, can somebody tell me where did we read this word contracting state earlier on, just for recall purposes? Anybody?
It's in DTRs actually when we did double taxation treaties and all.
Correct. So, Kalima, do you remember what is this contracting state? Miss Kalima, are you there? Can you please unmute?
I actually didn't, I wasn't there when that was being told.
Okay. So, but anyways, what Haya said, please remember when we have a double tax agreement. So in that agreement, there are two countries. Both are referred to as the contracting state. Okay, that's something for us to remember. So where under mutual assistance procedure, the person has presented a case to the competent authority of a contracting state, that will be in case of UAE FTA, on the basis that the actions of one or both of the contracting states have resulted for the person in taxation not in accordance with the provisions of the convention. When we say convention, that means double tax convention, double tax agreement, and the competent authorities are unable to reach an agreement to resolve that case within 2 years from the date. So key point, guys, remember 2 years. So there was a conflict and 2 years it remained unresolved from the date when all the information required by the competent authorities in order to address the case has been provided to both competent authorities. Then any unresolved issues arising from the case shall be submitted to arbitration if the person so requests in writing. So that's a key point. FTA and ZATCA start negotiating over a matter of a taxpayer, and all information has been provided, everything is there, but for 2 years matter stays unresolved. Then the taxpayer may step forward and say that, look guys, this is not happening, let us resolve to arbitration, because otherwise if we keep fighting legal angle, it is not going to be resolved. Both arguments are very strong, so let us do arbitration. These unresolved issues shall not, however, be submitted to arbitration if a decision on these issues has already been rendered by a court or administrative tribunal of either state. So that's a very interesting angle. So that's if the court has decided in either of the countries, there is a court decision available, then matter cannot be submitted to arbitration. So again, it's a point for us to remember. Unless a person directly affected by the case does not accept the mutual agreement that implements the arbitration decision, unless a person directly affected by the case does not accept the mutual agreement that implements the arbitration decision, that decision shall be binding on both contracting states. So the only key matter to remember here is that both ZATCA and FTA did the arbitration and they came to a conclusion. Now the ball is in the court of the taxable person, the person whose matter was being discussed. If he does not accept the arbitration, then this matter will take another route. But if the person accepts the arbitration, then that decision will become binding on both contracting states, and it will also become a precedent, by the way, and shall be implemented notwithstanding any time limits in the domestic laws of these states. The competent authorities of the contracting states shall, by mutual agreement, settle the mode of application of this paragraph. So that's how arbitration would happen. unable to reach MAP. This is a kind of a revision, what we just read. If the competent authorities are unable to reach the MAP agreement within 2 years after providing all information, then the person can request for arbitration. Arbitration is not dependent on the prior authorization by the competent authorities, because once the MAP procedures have been met, the unresolved issues preventing the conclusion of a MAP must be submitted to arbitration. So generally speaking, if MAP mutual assistance procedures fail, then a matter goes to arbitration. This means that broadly, whether the unresolved MAP progress to arbitration under the OECD provisions is dependent upon the applicant's actions. So the key point is information must be provided to entire information must be provided to both authorities. Arbitration and MAP. Arbitration is not an alternative or additional recourse, but an extension of the MAP, and MAP means mutual assistance procedures, today's topic. Enhancing the MAP effectiveness by ensuring that where the competent authorities cannot reach an agreement, a resolution will still be possible to submitting the matter to the arbitration. So naturally, MAP is not able to address, then it goes to arbitration. This means that the resolution of the case continues through the MAP, but resolving the particular issue, preventing agreement, is handled through the arbitration rather than by competent authorities. So even in case of arbitration, naturally there is an arbitration committee formed usually. So both authorities will need to agree on the on how this arbitration is going to proceed. Part 6 of the multilateral convention. So that multilateral convention is Model Tax Convention. So part 6 of the multilateral convention to implement tax treaty related matters to prevent base erosion and profit shifting MLI contains many of the procedural arbitration process features. Procedural arbitration features, for example, some state may include the arbitration clauses in their Article 25 MAP, but limits its application to factual cases such as transfer pricing disputes or a dispute on whether a permanent establishment exists. So guys, in this, what they're saying is that the mutual assistance procedures scope can be broadened or shortened. What are the we just read in the previous one of the previous slides that some of the key matters of international disputes which can arise. Can somebody recall those matters? I think first or second slide I think we saw. So because no one was there, I'm going to request Haya to repeat those things. What are the biggest matters of international dispute that can arise between two countries from a taxpayer's perspective?
I am really sorry to can't
If
recall.
we discussed, Haya, if you remember transfer pricing, that was the first one.
Yes, one was
And
transfer.
then we talked about PE, permit establishment.
Yes,
Whether a permit establishment has constituted or not
or not.
in country. What was the third one? How much amount of profit we can attribute to a permanent establishment, right?
Permanent establishments.
Right.
Yes.
So these were the key matters actually that can be the reason for a conflict arising between two countries' tax authorities. Okay. Some state may include arbitration clauses in their Article 25 map, but their scope can be like restricted, for example, to transfer pricing disputes or similar other disputes, or sometimes that scope limitation may not exist. Alignment with MAP, mutual assistance procedures. In relation to domestic legal remedies, the approach for arbitration would be to align with those used for MAP, which result in the application of the domestic legal remedies. So, in simpler words, the uh, the approach to arbitration uh, for these kind of tax disputes would probably need to be aligned with the domestic legal remedies being suspended. Why? Because let's read this paragraph again. In relation to domestic legal remedies. The approach for arbitration would be to align with those used for MAP, which result in the application of the domestic legal remedies being suspended while the arbitration process is being conducted. So the domestic procedures, domestic legal remedies, these would not apply, these would be suspended, and the arbitration procedure is going to take over. And usually in case of international dispute, even the arbitration approach is identified in a double tax agreement. The tentative agreement proposed by the arbitrators would be considered by the taxpayer, and if accepted, would result in domestic legal remedies being abandoned. So why? Because first of all, domestic legal remedies is for specific to one country, but this was an international dispute. So naturally, we read that the double tax treaty overrides the domestic law under the Vienna Convention, right? So it was the double tax agreement which was overriding, and for such disputes, we resorted to first stage was mutual assistance procedures, and that also did not happen. 2 years the matter was still in negotiation, dispute, and resolution. And finally, we went to arbitration. And after arbitration, then the ball goes to the court of the taxpayer. If the taxpayer says, I'm comfortable with the result of the arbitration, that's it. That's the end of it. That will resolve the matter. So now we are going to look at the UN Model Tax Convention. Guys, what I'm going to do is I'm going to take a quick break. I'll be back. Give me 5 minutes, okay, guys? We will resume this. I need a small break. So stay.
So,
Please do stay here. I'll be back. Hi everyone. Sorry for this break. So I'm going to restart this. Right. Where were we? So we were looking at the UN uh, Model Tax Convention. The UN has adopted Article 25 wording similar to that adopted by the OECD, except for three differences. So the first difference is that the UN allows 3 years for the competent authorities to resolve the dispute before removing it to arbitration, while OECD allows. So that's the first difference. Instead of 2 years, 3 years. It's a point for us to remember. Then the second clause says UN article provides for the competent authorities to remove the dispute to arbitration when the OECD grants the taxpayer the right to decide whether to remove the dispute or arbitration. So basically, provides the competent authorities to remove the dispute to arbitration when the OECD grants taxpayer. So there's a difference. In case of OECD model tax convention, the taxpayer is the one who says that, look, let us resort to arbitration. 2 years have happened, nothing is happening. But in case of UN model tax convention, it is the tax authorities that have the right to move to arbitration. And the third difference is that the UN model provides for the arbitration decision to be binding on both states and be implemented in the states unless both competent authorities agree on a different solution within 6 months after the decision has been communicated to them, while the OECD does not provide for a 6 months limit. So what is this 6 month limit? Again, I'm going to go through it again. The UN model provides for arbitration decision to be binding on both states and be implemented in the states unless both competent authorities agree on a different solution within 6 months. So that's a very interesting point. Although the arbitration is over, we came to a conclusion on the arbitration. But in 6 months after the arbitration decision has been made, if both states come to a different conclusion, something better, then the decision and the decision was communicated, then they can resort to that alternative method. But OECD framework does not provide for the same. In case of OECD, once the arbitration decision has been made it and accepted by the taxpayer, it becomes binding. These divergences show that the UN model favors the power of the country which has been refusing to resolve the dispute, which would most likely be the source state. So I'm going to ask this question here. There's a word mentioned as source state. So we discussed that the taxation originates. There are two particular words. So there is a doctrines of taxation are there. One was source based taxation, and what was the other one? Source versus. Can somebody tell me? The entire taxation uh, doctrine philosophy revolves around this. In my last lecture, I had mentioned this point. Can somebody repeat what it was? So source-based taxation versus, can anybody tell me? Come on, guys. Source versus residence. This was, if you recall, Haya, I think I should have gotten this answer from you. But anyways, source versus residence, source-based taxation versus residence-based taxation. This has been the major, uh, you know, uh, reason for evolution of taxation. So, but anyways, the point is, usually the problem is the source state where the geographical or other source of income is there. That entity, that country would, claim the taxation, but the residence country, they have the first right because the company is located, domiciled, originated in that country. They will claim that first right is ours. So that is the reason that these disputes would come in. Source versus residence, which for the UN would be the developing country. So, anyways, the point is that in case of a UN model, in case of UN model tax convention, uh, this model does provide a certain level of facilitation to the country which has been refusing to resolve the dispute. So, in the case of OECD, more power has been given to the taxpayer, actually. In this lesson, you learned that the global tax dispute resolution system is increasing the methods available for countries and taxpayers to use when attempting to resolve tax disputes, to include arbitration. So, until now, anybody has any questions or any matters to discuss?
Not from my side.
Okay, now we are going to come to the UAE double tax conventions. In this section, we learn whether the UAE double tax conventions include the arbitration clause. Firstly, it is not straightforward to identify whether the UAE accepts arbitration as a tool to resolve tax disputes, since the UAE does not publish a model double tax convention. So, uh, this sentence, can somebody tell me why this matter was emphasized by the curriculum, by the course writer, that UAE has not published a model tax convention? Can somebody comment on that? What does that mean? Other countries have published their model tax conventions.
Most of the developed countries, developed or developing country, has their own tax convention.
Absolutely. Very good. Right answer. Actually, US has published their tax convention. I think even UK has published. So usually it is a practice that the countries do publish their model tax conventions, that look, this is our standard double tax agreement. But now the world as a whole is reaching in an advanced stage, actually. Because since 2017, why do I emphasize on the year 2017? Because the OECD Model Tax Convention was finally agreed by a majority of countries in the year 2017. And if you open the Model Tax Convention of OECD, the year that is published on that is 2017. From that point onward, all the countries of the world knew that this Model Tax Convention is going to rule the world. All the countries will gradually start adopting this model. So after that, based on that OECD Model Tax Convention, countries also started to publish their own tax conventions. Now, why would still the country publish their own Model Tax Convention? Reasons could be, for example, one of the reasons, probably the biggest reason, is their internal domestic tax laws. Why sometimes the domestic tax law would have certain divergences or certain special treatments there. So considering those, you would find that the double tax convention might slightly differ from the model tax convention of a double tax convention of a country might slightly differ from the OECD's model tax convention. uh, uh, I have previously also cited that, for example, in case of the double tax agreement between UAE and Saudi Arabia, while the entire double tax agreement is very similar to the model tax convention, same clauses have been taken up. But in one case, they used UN model tax convention instead of OECD. Two of the biggest model tax conventions of the world, which the entire countries of the world are following, are number one, OECD model tax convention, and number two, UN model tax convention. So very rare cases, particularly for example, for fee for technical services, UN model tax convention is referred usually. So in that Saudi Arabia UAE model tax double tax treaty, the fee for technical services, that clause is actually taken from the UN Model Tax Convention. Otherwise, all the rest of the agreement is based on OECD Model Tax Convention. Without a model, it is possible. It is possible to identify a policy by reviewing the DTCs the UAE has entered into, and it is evident that the UAE accepts MAP because a MAP article has been included in the UAE's recent DTCs. So MAP, again, mutual assistance procedures, which is the topic of today. And in majority tax conventions of UAE, this MAP article has been included. While the OECD model map includes arbitration, the UN model provides companies with a choice as to include arbitration or not. That's a big difference. So UN model provides a choice to include arbitration or not, but OECD model mandatorily includes the arbitration clause. It is compulsory there. Reviewing the published UAE DTCs concluded between 2019 and 2022. Actually, this is an old writing. Now this is year 2024, and even after September 2022, multiple double tax agreements have been signed with UAE. For example, I can tell you that with I think with Kuwait and with Qatar also, UAE has signed, and more countries also have been included. For example, the South Sudan, Indonesia, Chile, and Israel. It is evident that none includes the full OECD article, which means that none provides a right for the taxpayer to request arbitration. So that this we are discussing the UAE double tax treaties basically, when the competent authorities have been unable to resolve the dispute by map. So whenever you guys, through one shortcoming that we face with the UAE double tax agreements is that you cannot find all the DTAs published on the Ministry of Finance website, or for that matter, Federal Tax Authority's website. So you have to look at the other countries' websites. Like for example, in case of Sudan or Indonesia, you will not find those double tax agreement on the FT or Ministry of Finance website. But if you go to the same websites for Sudan or Indonesia, particularly Indonesia, you will find the complete, double tax agreements available. The absence of a right to request arbitration does not prevent the competent authorities from mutually agreeing to an arbitration to resolve the dispute. So, I mean, even if it is not included in the DTA, the two authorities can, resort to arbitration if enough time has passed, 2 years in case of OECD or 3 years in case of UN. Subject to the following comments on the implication. If a tax dispute arose with another jurisdiction, when I say jurisdiction means country, which has joined the multilateral instrument, it is unlikely that a company executive of a UAE company being audited would be correct were the person to state that the company's tax dispute would be resolved in the company's favor through relying on or stating that they had been advised that it could be relied upon arbitration to resolve the matter. So, this is the tax implication basically, that if a company executive says that this matter will be resolved through arbitration, that this is a wrong statement basically. Why? Because the double tax agreements of UAE not necessarily give the right to the taxpayer. In such circumstances, the tax provision and tax expense should be carefully reviewed. Now, UAE MLI, UAE multilateral instrument. So the UAE Ministry of Finance signed the MLI and sent a listing of reservations and notifications to the MLI depository on 1 September 2019. So MLI depository, again, I'm repeating that depository in this case means the Department of OECD, where all the countries of the world, when they sign a double tax agreement, they deposit it in the depository. This is the formal process by which the counterparts are formally notified by the UAE which MLI articles it accepts and which articles it does not accept. On reviewing the UAE deposited listing, it is evident that there is no reference to the MLI Article 6 arbitration provisions. The MLI Part 6 permits a country to choose to apply the arbitration part of the Double Tax Convention to which it nominates they should apply, but Part 6 of the MLI only applies to both parties to the Double Tax Convention. Mutually accept, it should apply. So, in short, arbitration is a matter that even if it is not addressed in their double tax agreements, the two authorities can agree to getting into arbitration. Since the UAE has not notified the depository, it has adopted the arbitration provision. It follows that the UAE DTCs will not presently be updated by extending the MAP article to include the arbitration provision. So, in short, if you look at any double tax agreements of UAE, the MAP article may not have arbitration clause in it. In this lesson, you learned, okay, let's move to the next thing. Bilateral investment treaties. What we read up till now was basically mutual assistance procedures in case of tax disputes. Now we are coming to another angle, another area, which is bilateral investment treaties. So, in this lesson, you will be introduced to the investment treaty provision allowing an investor to file a claim against a state for a serious reduction in investment value or a serious constraint on the outbound transfer of profits or returns arising from a change in tax law or the withdrawal of tax concession. So, naturally, you had an investment in a country and suddenly tax exposure arose from maybe 10%, it went to 30%. And because of this issue, the business valuation was affected. So naturally, there was a drop in valuation because of the tax exposure increase. So investment treaties address this type of a matter. Using the knowledge, you can validate any impairment claims in the books of accounts of a UAE company or any claim by a UAE company executive that a tax dispute will be resolved. Yes,
Just one invitation.
yes, please.
कब है डेट वेट पढ़ो क्या है
1st October to 12th January. Very long time.
I think somebody is speaking. Guys, can you, if there's no question, can you please like mute your mics, please? Thank you. BIT and TIPs. Let's see what these mean. Bilateral investment treaties and treaties with investment provisions. Let's see what these are. Having determined that a cross-border tax dispute may be resolved by mutual assistance procedure, but if it is not, the dispute will not be resolved through arbitration. You are therefore introduced to the dispute resolution provisions in investment treaties and under human rights conventions. Let's look at these two. So the two things that we see are bilateral investment treaties and treaties with investment provisions. Yes. The significance of these treaties to the world trade is clear when seen against the background in September 2022. There are 2,861 bits, of which 2219 have been enforced. And at that date, there are 431 treaties with investment provisions, of which 336 have been enforced. So there are, in short, there are thousands of such treaties which address the the investment exposure, because countries have foreign direct investment programs in force usually. So those investors who are foreign basically, so they have a right to claim later on if their original understanding was substantially changed in a country. Bilateral investment treaties. A BIT, bilateral investment treaty, is an agreement made between two countries containing reciprocal undertakings for the promotion and protection of private investments made by the nationals of the signatories in each other's territories. Naturally, I mean, these agreements establish the terms and conditions under which the nationals of one country invest in the other. Naturally, this is called foreign direct investment, including their rights and protections. BITs provide protection against the illegal nationalization and expropriation of foreign assets and other actions by a BIT signatory. So you see expropriation of foreign assets or illegal nationalization. So in some countries, for example, I can remember in Pakistan, there was a nationalization that happened in the 1970s, I believe, where the private sector major companies were nationalized. So that kind of crushed the economy, and a lot of investment went out of Pakistan. Same thing has happened in other countries of the world as well. And foreign a foreign investor's assets in the other country can also be expropriated by an action of the government. So these investment treaties provide protection against that. In relation to overriding principles, bilateral investment treaties are negotiated between the signatory parties. Their terms vary, but they generally include the requirement for national treatment, most favored nation treatment, fair and adequate treatment, and compensation in the event of expropriation. We are going to look at these. Expropriation is the government seizure of property. If anybody did not know the meaning of the word expropriation, so that's the meaning. If I remember correctly, the same has been addressed in IFRS as well somewhere. Expropriation is the governmental seizure of property or a change to existing private property rights, usually for public benefit. One of the main bilateral investment treaty protections allows foreign investor to sue states directly by submitting claim for a BIT, bilateral investment treaty breach, to arbitration rather than to local courts. So, more to arbitration and less to local courts. Bilateral investment treaties are intended to guarantee certain standards of treatment, which can be enforced via binding investor to state dispute settlement procedures outside the domestic juridical system. Again and again, you are getting a reference to this fact that whenever there is a relationship between two countries, whenever there is an agreement or a treaty between two countries, it overrides the domestic juridical system. Developing countries accept restrictions on their sovereignty in terms of arbitration in anticipation that the protection from political and other risks would result in an increased foreign direct investment. So they allow, they themselves accept it. So it's like their sovereign decisions, which is the governmental decisions, can be, challenged through the mechanism provided by bilateral investment treaties. Treaty with investment protection, with investment provisions. Let's look at that. TIPS being together various types of investment treaties, none of which qualifies as a bilateral investment treaty. So there is a difference. Bilateral investment treaty, the very purpose of this treaty is investment itself. But TIPS, on the other hand, is a lighter treaty. Treaties with investment provisions. So investment is one part of these treaties, but they're not, their entire ambit is not on investment. The three main types of TIPS are broad economic treaties containing obligations commonly found in bilateral investment treaties. For example, a free trade agreement within an investment chapter. Treaties with limited investment related provisions. For example, those concerning establishment of investments or free transfer of investment related funds. This would discuss the establishment of investments or free transfer of investment related funds. And particularly this becomes very important in the context of UAE because here the international wealth is poured in to a great extent, and especially fund-related treatments become of paramount importance. Treaties containing framework clauses on cooperation in the areas of investment and or for the mandate of future negotiations or investment issues. So, future outlook is also addressed in such provisions. Asset protection clauses. Before we move forward, I would like to ask some of you who have been doing tax practice before as well. I think most of you might be aware of the existence of double tax agreement. Where would the bilateral investment treaties or tips come in handy when you're doing any advisory work for international scenarios? Can somebody share their perspective? Yeah, Haya or is Mujaddid there? I don't think Mujaddid is there, but or Pankaj and or Apsar. Anybody would like to contribute to this?
I'm not in practice, but basically the DTA comes into picture when you are having international transactions and there is a situation where you are paying the taxes in the source and the resident country
Hmm.
on the same income.
Right. Okay. But where would the investment treaties become helpful? What would be the scenario where the investment treaties would become helpful?
When a company wants to invest in another country, in another company which is resident of another country, when the investment, yeah,
Yes, correct. That is very right. See,
or
this, yeah, go ahead.
no, you go ahead.
So, multiple scenarios can be there. Like, for example, foreign direct investment, which you just mentioned, Haya, that is right. Like, one company in a country is considering to make a major investment in another country, right? Either in an existing company or maybe setting up their entirely new business over there. That's foreign direct investment. And they are concerned about what would be the future of that investment. Is it likely that we may face expropriation, for example, right? Or, okay, we will open the company in that other country, but what will happen to our profits? Can we repatriate our profits? Would there be a foreign exchange remittance related matter that will be involved? Major exposure would or compliance obligations would be there. Would there be any further levies on that, right? This is one example. Then
And can it be in merger and acquisitions also?
absolutely, it can be in merger and acquisition also. Why? Because any merger might involve exchange of shares. Acquisition is an easier thing. You are acquiring the entire business, so that is the investment, straightforward investment, right? So, but more than that, see, around the world, ultra high net worth individuals, they want to park their money in safe places, right? Through investment or through fundings. As tax practitioners, particularly, this is one of the major areas that you are going to encounter. I have faced this multiple times. So many of the ultra high net worth individuals, I've raised this dialogue, and they were concerned about only one or two major things. That, like, first thing, is our investment safe? But everybody knows in UAE, investments made are pretty safe if you really think about it. Uh, that's one area. But then the another angle is that, are we able to repatriate our profits, like from UAE, if we want to bring our wealth, like, or certain part of our profit to another country? Does that is it very difficult to do that, to move money out of UAE, right? Um, I can tell you in Saudi Arabia, sometimes there are, issues. It's not very easy sometimes to move the money out of Saudi Arabia or certain other countries of the world, unless you undergo certain scrutinies. So these are the matters where, in addition to the double tax agreement, investment treaties, strategic decisions of investment, that's where the bilateral investment treaty can come to your help. If you're writing an advice, for example, tax advice or tax and investment related advice, it will not only be double tax agreement that you will refer to. you will need to refer to the BIT as well, bilateral investment treaty as well, suggesting that, look, since you have reached out to us seeking advice on whether it is worthwhile to establish your investment, foreign direct investment in UAE, we can tell you that UAE has done this bilateral investment treaty with your country of residence, Sweden, Denmark, any USA, any country. This is the bilateral investment treaty that exists. And as foreign direct investor, you have these protections and these rights available to you. So these are the factors for you to consider while making an investment in UAE. So moving on, for taxpayers to resort to a BIT, bilateral investment treaty, or a TIP, which is treaties with investment provisions, for assistance in resolving a cross-border tax dispute, that agreement must contain asset protection provisions concerning governmental expropriation, providing fair and equal treatment, and allowing the free remittance overseas of a wide range of payments. Naturally, these are the biggest. Actually, this is a beautiful paragraph. Actually, the 3 points that they have mentioned, these are the biggest concerns for any investor. So, preventing expropriation. First point, will our assets be taken away? Will the government take away our investment? In relation to preventing expropriation, the usual wording is that a state is not permitted to expropriate or nationalize an investment falling in the class defined in the treaty, either directly or indirectly, by measures adopted to expropriate or nationalize, except when expropriation has a public purpose, was arranged in a non-discriminatory manner, resulted in payment of compensation on a prompt, adequate, and effective basis, and in accordance with the due process of law. Now, for example, uh, have you heard about sanctions list? I think Mr. Tanu is here. He's dealing with the internal audit, so he's the expert on that. But for everyone's benefit, uh, anti-money laundering related law, and the body which is called Financial Action Task Force, they recommend that the countries must comply with the anti-money laundering regulations. They need to ensure that, those countries which are sanctioned countries or they're on the sanctioned list, the transactions with such countries are a big red flag. So if any investor from such countries such as North Korea, Iran, I think Afghanistan included, those people are making an investment, there may be a they they it will it their risk will be much higher, right? So uh, whereas, like, in case of other countries, investment treaties are going to provide them a lot of protection, and these matters will be covered as we saw in accordance. So expropriation can, it can happen despite the investment treaties present, but in very limited scenarios which have been outlined here, which is for public purpose, public benefit, non-discriminatory manner. So non-discriminatory will mean that, a country is okay, it is not on the sanction list, but maybe the foreign relations are not, good. This happened in GCC some time back, if you recall. So that there could have been, the allegations of discrimination could step in that scenario. Compensation. Compensation will be prompt, adequate, and effective when it is paid without delay, first of all. Uh, Equivalent to the fair market value of the expropriated investment when calculated immediately before the expropriation took place. So this is the scenario where the worst fears have happened. Assets were expropriated. Even in that case, there are certain protective clauses, like, first of all, it should not be delayed, the compensation for the assets taken away. Secondly, fair market value arm's length principle must apply. Does not reflect any change in the value occurring because the international expropriation had become known earlier. So, market sentiment. Just because there was a news in the market that this country is about to nationalize industries, suddenly the market value went down, share price went down. So that will be disregarded while calculating the compensation. The compensation is fully realizable and freely transferable. So, this is only a recourse after the expropriation has happened. Outbound payments. Outbound money transfers must be allowed to be made freely and without delay into and out of the territory. The outbound payments which are likely to be covered are contributions to the company's capital, including the initial contribution at incorporation. So these are the payments, outbound payments. So first of all, capital contributions, financial returns on the investment, profits, interest, etc., which would include dividends on stocks. So this is not interest only, dividend, etc. Proceeds from the sale of all or any part of the covered investment, or from the partial or complete liquidation. So liquidation proceeds or sale proceeds of the company. Payments made under a contract, including a loan agreement, which includes principal and interest. That's where the interest also came in. So there was a financing arrangement. Principal plus interest both should be freely transferable. Payments arising out of a dispute, which may be with the government, supplier, contractor, or customer. So if there were any payments to be made, collections to be made, they should with any party, including government, supplier, contractor, etc., customer. Those should be transferable. Earnings and other remuneration of foreign personnel in connection with the covered investment. So that's where the personnel related payment comes in. That should also be allowed, which includes salaries and on costs paid to the expats temporarily based in the territory. Furthermore, transfers will not be free without delay unless payable in a usable currency at the market rate of exchange prevailing at the date of the transfer. Yeah. Were company to be prevented from repatriating capital or dividends, and were the reason for preventing the repatriation relating to a change of tax law, and were the change not to apply to all taxpayers in the same circumstances, then if the financial consequence of the discriminatory tax change were large, there would potentially be expropriation. So there would potentially be expropriation. So it is one example of an expropriation, basically, where a company uh, uh, was prevented from repatriating capital or dividend because of the major changes in tax laws, uh, and it does not apply to all taxpayers. So if you really think about it, this is discrimination. So only to a particular class, this prevention or embargo was applying, then this will be seen as expropriation. It will be covered under expropriation. Dispute settlements. So in some cases, a company may conclude that there has been expropriation. Auditors must then understand the taxpayer's rights under the bilateral investment treaty or treaty with investment provisions to seek redress, recourse, basically. The distinctive feature of many bilateral investment treaties is their allowance for of an alternative dispute resolution mechanism. So yeah, I mean, ADR is predominant in the world, alternative dispute resolution, whereby an investor whose rights under the bid have been violated could have recourse recourse to the international arbitration. Uh, Here in UAE, Dubai International Arbitration Center is famous for this. As a matter of fact, it serves sometimes at a regional level for resolving disputes, often under the auspices of the International Center for the Settlement of Investment Disputes. So, this is the international body, International Center for the Settlement of Investment Disputes, rather than suing the host state in its own courts. So it is kind of an international, the analogy would be the international court, basically. Investor state dispute settlements. Much information is available explaining the investor state dispute settlement process and the category of disputes which ISDS, Investor State Dispute Settlement Hearing. How does it happen? We're going to look at it. So far as the process is concerned, ISDS claims, and ISDS stands for International State Dispute Settlements. Claims are often brought under the ICSID, which we read earlier on, which is the name of the body which deals with international disputes for investment, International Center for Settlement of Investment Disputes. So they have issued certain rules. Investment dispute, basically, the investment dispute agency, you might call it for easy wordings. They have issued some rules. Uh, so International Center for Settlements of Investment Dispute of the World Bank. So it's a World Bank entity, or one of the several other international arbitral tribunals governed by different rules or institutions, such as the London Court of International Arbitration, the International Chamber of Commerce, the Hong Kong International Arbitration Center, or the UN Citral Arbitration Rules. So multiple bodies around the world are available where such international disputes, arbitration related matters, can be referred, and both parties will agree to it. Investment disputes can be initiated by corporations and natural persons. In most cases, investment tribunals are composed of three arbitrators, one being appointed by the investor, a second by the state, with the third usually chosen by agreement between the parties or their appointed arbitrators. So third one is mutually agreed. Rest of the two represent one investor and one the state. And what we are discussing is the dispute with a state, basically, when the investor has a dispute with the state. Other individuals cannot initiate a claim against a state under an investment treaty, and an individual or state cannot initiate a claim against a foreign investor under an investment treaty. So that's a very interesting thing. The state also cannot raise a dispute. It is the investor who can raise the dispute. With a view to improving and refining the ISDS process, the UNCTAD review of 2020 investor state arbitration decisions, IIA reform issues at a glance stated that the 2020, the matter being considered for further include tax matters. So these are basically further considerations to investment dispute resolutions. What are these? The biggest one, tax measures. Using most favored nation treatment to import provisions from respondent states, IIAs, with third countries. So what was this IIAs? We have to look at it. I don't think it has been mentioned here, but anyways, I think it is going to come at a later stage. IIAs has not been identified here. Using most favored nation treatment. So yeah, this most favored nation treatment also has a so basically it's a status granted by one country to certain other countries which are seen as the most favored nation in terms of investment, in terms of bilateral relations. The meaning of fair and equitable treatment, legitimate expectations, and regulatory stability. Again, these are future outlook that we're looking at. Indirect expropriation, umbrella clauses, contract claims, and other obligations. So indirect expropriations can happen whereby the government has not directly taken up, but there are other modus operandi or other methods used whereby the person cannot, for example, repatriate profits or capital or dividends to their country. So we saw it. An example was tax measures, your tax policy changes, or such high rates were introduced or levies were introduced that the person is unable to repatriate profits or capital. That would still be seen as expropriation. That is what is referred as indirect expropriation. Umbrella clauses, contract claims, and other obligations. Consent to investor state arbitration. So, investor state arbitration related matters are also being seen as a future consideration, which is going to improve this investment dispute resolution mechanism between who? The investor and another state, requiring and limitation period for the bringing the investment dispute claims. What is the maximum time in which an investment dispute can be brought to a state? Matters resolved by ISDS. In relation to the category of matters the ISDS is being asked to resolve, UNCTAD data Facts on Investor State Arbitration 2021, with a special focus on tax related ISDS cases, confirms that investors have challenged tax related measures in 165 cases. About 60% of the tax related ISDS cases relate to activities in the service sectors such as supply of electricity, gas, steam, and air. So 75 cases. Information and communication, for example, telecom ICT companies basically. There were 11 cases for ICT. Wholesale and retail trade, 7 cases were there. Uh, Construction, for example, construction of buildings and civil engineering. Again, some 4 cases were there. Arts, entertainment, and recreation. For example, gambling and betting activities. There were 3 cases. Transportation and storage. Again, there were 3 cases. Financial and insurance activities. Again, 3 cases. So these are the examples of the investment dispute cases that were brought around 165 cases. So what we are going to look at is, some of the cases now, high profile cases. Imposition of capital gains tax. So Haya, do we have capital gains tax in Pakistan?
Yes, we do have.
And what would that be?
On your assets, land, buildings, houses, and it depends on the year you have retained them. And for first 2 years it is exempt, and then you will be taxed, and then on precious metals, etc.
Right. Okay. So basically, on the disposal of such
And
capital
shares
assets
also.
and even shares also, there
Yeah.
is a tax imposition of capital gains tax. For example, the cases of Cairn versus India and Vodafone versus India, uh, each of which concerned the taxing by India of profits earned by companies one or more tiers away from India, when the underlying asset being transferred represented stock in an Indian company. So this was an example of a capital gains tax dispute that arose. Tax investigations and large tax assessments. Tax investigation and large tax assessment, for example, in the cases of Hali Enterprises versus Russia, Veteran Petroleum versus Russia, and Yukos Universal versus Russia, all concerns, all concern claims from a series of actions undertaken by Russia against Yukos, including arrests, large tax assessments, and liens, and the auction of the main Yukos facilities, which allegedly led to the bankruptcy of the company and eliminated all value of the claimant's shares in Yukos. So that was a large tax assessment dispute. Regulatory changes to feed in tariffs for renewable energy production. So regulatory changes to feed in tariffs for renewable energy production. For example, in the case of PV investors versus Spain, Tirana and construction investments versus Spain. So these were basically energy related case that was brought in. Increase in windfall profit taxes and royalties. So anybody knows what is windfall profit? So recently during Russia-Ukraine war, what happened to the petroleum prices? They skyrocketed, guys. So And who benefited because of the skyrocketed petroleum prices? Who benefited the most? The oil producing countries. So these were windfall profits, but luckily or interestingly, windfall taxation was never in place in Saudi Arabia, Oman, UAE, etc. An increase in windfall profit taxes and royalties, for example, in the cases of Burlington versus Ecuador and ConocoPhillips versus Venezuela, arising out of Ecuador's enactment of a law imposing a 99% windfall levy on foreign oil revenues as a result of an oil spike during 2002. So these include the government's decision to migrate to service contracts and the subsequent process to terminate the investors' production sharing agreement. So this happened in Venezuela, whereby almost 100% of the profit was taken back. Withdrawal of subsidies or tax exemptions. A withdrawal of subsidies or tax exemptions can be seen, for example, in the case of Micula versus Romania, or the amendment of specific incentives in the context of Romania's accession to the European Union. So, if you remove subsidies, naturally the investment is impaired. So that's a classic scenario whereby an investor may claim a dispute with the state. Now, knowing that global governance arrangements exist that permit tax disputes between an investor and a state to be resolved under an investment treaty, you will next learn whether the UAE's investment treaties contain any or all of these rights, which allow UAE investors to pursue tax claims against foreign governments. So let us have a look at UAE investors' rights. Now, I think that's what it is coming up. UAE network, let's look at it. The UAE has a wide network of bits. By the way, let me clarify one point to you. Uh, as far as I have seen, in all of the 6 GCC countries, there is no windfall taxation. But so any investor coming into these countries can enjoy as much profit as they want to. But let's look at it from the other side of the table. What happens if a UAE investor is making investments abroad? UAE has a wide network of bits and tips, as would be expected for a country marketing itself as a hub for global investment, naturally. At the beginning of October 2022, UAE had entered into 108 bilateral investment treaties, of which 56 were in force and 14 treaties and investment provisions, of which 7 were effective. The most recently signed and enforced UAE tip is with India, which was signed on 18 February 2022 and was enforced on 1 May 2022. And the most recently entered into and enforced bit was with Hungary. In order to render discussions of the UAE's network manageable, the focus is given to the UAE-Hungary bilateral investment treaty. The most recently signed and effective entered into BIT, and to the UAE-Israel BIT. Again, this is a recent one. I think a few years back it was signed, given the unique circumstances surrounding the parties entering into it. Actually, out of these 2 treaties, the between UAE Hungary and UAE Israel, the infamous one is between UAE and Israel, because it was a big subject matter in the news and all that. In relation to the UAE Hungarian BIT, its expressed purpose is to stop investments from being nationalized or directly or indirectly expropriated and aligned with the global model. So that's the Hungarian bit. So what we're looking at now is a quick recap. Where an expropriation occurs, it must be carried out with the purpose of with the process of the law on a non-discriminatory basis and be accomplished by provisions for the payment of prompt, adequate, and effective compensation. this aligns with the global market. That so what we are looking at is with the treaty of UAE with Hungary, fair market value. The compensation must equal the fair market value of the investment expropriated immediately before expropriation or impending expropriation. Impending expropriation became public knowledge, whichever is earlier. Why is this clause there? Why? Because once the knowledge becomes available to market that there is an expropriation about to be uh, executed, the market value of the shares will drop. So the right reference point would be uh, the normal stage of the investment where there was no such issue of expropriation highlighted. Include commercially reasonable interest and be made without delay, be effectively realizable and freely transferable in freely convertible currency. So basically no aspect of it should prevent the benefit accruing to the investor if his assets have been expropriated. Free transfer. In relation to free transfers, the state shall permit the free transfer of payments related to investments and returns which shall be made in freely convertible currency and in accordance with the laws and regulations of the contracting party where investments were made without any restrictions and undue delay. So we've discussed this time and again. So basically these are the three major considerations. Expropriation, the purpose should be there. Proper. It should be non-discriminatory basis. This was expropriation. Fair market value. It should be the compensation value should be that which was predominant or prevailing before this expropriation became common knowledge. And then it should be freely transferable. Even the currency has been addressed that it should be usable and convertible. The qualifying transfers include capital and additional amounts to maintain or increase the investment. Then the returns, meaning the profits, amounts required for payment of expenses arising from operation of the investment, such as payment of royalties and license fees or other similar expenses, payments in connection with the contracts, including loan agreements, proceeds of total or partial sale or liquidation of the investments. So basically capital contribution, wages or other similar earnings of natural persons engaged from abroad in connection with the investments. So personnel related payments, basically payments arising out of settlement of a dispute. So it's some dispute with either the government. Four things we had read earlier on. It was with it. This dispute was with the government or a contractor or a supplier or a customer. All such payments are also freely transferable. In the main, the qualifying contents in the Hungarian DTC align with the global market. The Hungarian limits the timing of the transfers to date, not before the investor had fulfilled all of its related financial obligations according to the law and regulations in force. So if there were already genuine financial obligations, that they have to be settled naturally. Of the contracting party in the territory for which the investment was made. The provision can be interpreted as preventing a transfer in the circumstances in which a cross-border tax dispute has arisen. That's why this, because it clearly says that the any financial obligation in line with the laws and regulations, they need to be settled first in order for compensation to take effect. Now we're coming to the famous UAE-Israel Promotion and Protection of Investment Treaty. In relation to the UAE-Israel Promotion and Protection of Investment Treaty, while the inclusion of the normal provisions along with the lines of the Hungary bit was not to be unexpected, the treaty includes certain interesting taxation provisions. Okay, let us look at it. Particularly, the noted article number 10, taxation measures, provides that nothing shall impose obligations with respect to taxation measures except as expressly provided in Article 2, treatment of investments, and 6, expropriation and compensation. So, further, that nothing in the agreement shall affect the rights and obligations of either party under any tax convention. Wow. So, particularly any bilateral DTCs, but likely would include the MLI. So, this treaty is overriding the double tax convention as well. And further, that nothing in the agreement shall affect the rights and obligations of either party under any tax convention. So this treaty overrides the double tax convention between Israel and UAE. In the event of any inconsistency between this agreement and any such convention, that convention shall prevail to the extent of inconsistency. The Article 10 footnotes stipulates that Article 10 is to be interpreted in accordance with the Annexure C, taxation and expropriation. So let us look at what Annexure C has to say. Taxation and expropriation contains matters of detail which are most unlikely to be found in other UAE treaties, and for that reason, it's reasonable to conclude that this represents Israel's negotiation position. So basically, this is kind of giving reference to other treaties of UAE as well. So if a measure has not been implemented in other treaties at a large scale, then this strengthens Israel's position to negotiate on such matters. The determination of whether a taxation measure in specific fact situation constitutes an expropriation requires a case by case fact based inquiry which considers all relevant factors relating to the investment. So in case something arises, then the consideration will be given on a case to case basis, including the factors listed in Annex A, which in the main relate to the diminution in value caused by the state action for the investor. So in short, like the treaty is a little bit open ended, and it it is a result of negotiation between the two countries. There are 4 considerations to take into account: imposition of taxes, international tax policies, non-discriminatory taxation, and existing measures. Let us look at these one by one. Imposition of taxes. The imposition of taxes does not generally constitute expropriation. Obviously, it is not in general expropriation, and the mere introduction of a new taxation measure or the imposition of a taxation measure in more than one jurisdiction in respect of investment generally does not in and of itself constitute an expropriation. It's a fair point. Just because UAE has introduced corporate taxation, that does not mean an expropriation measure has been incorporated or put into force. International tax policies. A taxation measure that is consistent with internationally recognized tax policies, principles, and practices should not constitute an expropriation. So, naturally, I mean, if the taxation measure introduced is in line with the international framework, then it will not constitute an expropriation. In particular, a taxation measure aimed at preventing the avoidance or evasion of taxation measure generally does not constitute an expression. Again, this is reference to double taxation. So it will any such provisions, for example, a double tax agreement introduced would not mean that there is an effort to expropriate assets. Non-discriminatory taxation. A taxation measure that is applied on a non-discriminatory basis as opposed to a taxation measure that is targeted at investors of a particular nationality or at specific taxpayers irrespective of their nationalities is less likely to constitute an expropriation. So yeah, I mean, since in the tax law itself, I hardly think that any tax laws of the world target any particular nationalities or even address any particular nationalities. Uh, so in that sense, non-discrimination is already there embedded into the tax law of UAE. Existing measures. A taxation measure generally does not constitute an expropriation if it was already in force when the investment was made and information about the measure was publicly available. So I do not see the date of signing of this treaty, but nonetheless, as I recall it, it was before the introduction of corporate tax law, but VAT was already in place in UAE. Lesson summary. In this lesson, you have been introduced to the nature of disputes which may be resolved under an investment treaty settlement provision. You should also be able to determine whether and if so to the extent that those disputes may be tax related. Having this knowledge is intended to equip you with the necessary skills to validate whether claims made by company executives that impairment should be reversed or provisions for tax not to be made due to investment treaty provision is valid. So yeah, I mean, although it says that no tax related matters are going to affect the, for example, in case of the Israeli treaty, it says that tax related, if you read this, provides that nothing shall impose obligations with respect to taxation measures except as expressly provided in Article 2. So in short, doesn't matter if the company is from Israel or whereby it is clearly mentioned. Based on the criteria that we have seen, the UAE corporate tax will apply to Israeli companies as well. Why? Because this meets all these four standards. Now we are coming to human rights and taxation. So we are going to look at it. If there are any questions, any points to be raised by anyone, I'm more than happy to answer. Okay, so I'm going to move forward. In this lesson, we consider whether human rights conventions to which a non-UAE state is a signatory may provide a UAE company with rights to sue that foreign state for settlement of a foreign tax dispute, or whether an inbound UAE investor may have rights under a human rights convention to which the UAE is a signatory to sue the UAE government for a tax dispute which constitutes a breach of human rights. So we'll look at whether a UAE investor can protect under the human rights framework of the world their investments or tax related matters, and vice versa. A foreign investor can take the necessary legal measures or not. UAE outbound claim. In relation to the rights which a UAE entity can rely on to resolve a tax dispute with a foreign government, they generally fall under various human rights conventions. Now, please remember, we're talking about a UAE entity. Okay. They generally fall under various human rights conventions, with the two most relevant being the European Convention on Human Rights, short form European Convention, and the United Nations International Convention on Civil and Political Rights, so ICCPR. Whether a company may successfully use these conventions is not entirely clear, although there is growing body of jurisprudence to suggest it can. Let us look at how it is possible. Perhaps the place to start this lesson's analysis is to study Baker Casey's writings. He is a leading thinker on human rights and tax and has written on tax and human rights as far back as 2001. In that publication, he wrote GITC Review. Personally, I do not believe that taxation and human rights are in any way irreconcilable or conflicting. I think human rights are a fundamental aspect of taxation. Human rights limit what governments can do to their citizens, to people affected by their decisions. So, a very interesting angle that tax does fall under human rights. Very interesting angle. He went on to write, 41 countries are members of the Convention for the Protection of Human Rights and Fundamental Freedom, and all of them are subject to supervision by the European Court of Human Rights, which sits in Strasbourg. The Strasbourg organs are the bodies that supervise the European Convention, which is the European Convention on Human Rights. And in the last 50 years, the Strasbourg organs have heard a surprisingly large number of tax cases. When I did some research a year ago, I found 240 tax cases had gone to Strasbourg. In the last 12 months, there were about another 36. While this is not a large number of cases, it is representative of a growing trend. Very similar protections exist under the UN Convention, the International Covenant on Civil and Political Rights, ICCPR, which is available to all member states of the United Nations. So there are 145 states parties to the ICCPR. Not all 145 states allow taxpayers to challenge the government. In fact, only 95 allow the challenge. So all there are 145 states that are part of the United Nations, and interestingly, not all of them allow. Only 95 allow a challenge, and so fewer cases have gone to the New York or Geneva that have gone to Strasbourg. Nevertheless, there is a small but growing tax jurisprudence of the Human Rights Committee. So the two conventions have broadly similar articles which are of particular relevance to tax. There is, so under the convention, so we have just read, two different conventions. One is the Human Rights Convention, and then there is the ICCPR. Let's look at the rights of a human being. What are those rights? Free trial, fair proceeding if one is challenging a tax assessment, the right to respect private and family life, prohibition of discrimination, and protection of property. These are basic human rights. Those are the four main articles of the European Convention. There is no equivalent provision in the ICCPR for the protection of property. Very interesting. The United Nations ICCPR does not have a right for the protection of property. The most important of these provisions in the tax context is the right to a fair trial. This is to be found in Article 6 of the European Convention, and there is a parallel provision in Article 14 of the ICCPR, which begins, in the determination of his civil rights and obligations or of any criminal charge against him, everyone is entitled to a fair and public hearing within a reasonable time by an independent and impartial tribunal established by law. So basically, we should remember these 4 points under the human rights conventions, which is fair trial, fair processing if one is challenging a tax assessment, right to respect private and family life, and prohibition of discrimination and protection of property. Article 6 and Article 14. Baker asks whether the Article 6 and Article 14 guarantees apply to tax proceedings, and concludes that the right to a fair trial, which is Article 14, and the rights that Article 6, every human being has the inherent right to life. This right shall be protected by law. No one shall be arbitrarily deprived of his life, are relevant to tax disputes. Every human being has the inherent right to life, which is Article 6. Let's read. In relation to Article 6, he argues it applies to tax only if the tax dispute is of a criminal nature, but tax lawyers would normally conclude that a tax matter is a civil obligation and not criminal charges. Therefore, intuitively, Article 6 would not apply because people, the predominant view is that this is a civil tax as a civil obligation and not criminal charges cannot be brought. He confirms, however, that the Strasbourg organs have said that this phrase has to be given an autonomous convention meaning. What is that? A meaning which has to be common from Cork to Vladivostok. So I think this is a case that they are mentioning. In particular, they have noted that in many continental European countries which do not apply common law, tax is an area administrative or public law. It is not a civil law matter. So, uh, the summary or the crux of it is that uh, the tax related conflicts or unfair treatments should be allowed to be processed as criminal offenses as well. It's not only a civil liability. Broadly, the European Court has said that Article 6 does not apply to ordinary tax proceedings, but applies to penalty proceedings or fines. So it's an important observation for us to remember. European Court has said that Article 6 does not apply to ordinary tax proceedings, but applies to penalty proceedings or fines. Right to a fair trial, Article 14. In relation to the meaning of a right to a fair trial, which is Article 14, the European Convention, the parallel provision is Article 14 of the ICCPR, states that in the determination of his civil rights and obligations or of any criminal charges against him, everyone is entitled to a fair and public hearing within a reasonable time by an independent and impartial tribunal established by law. This is a repetition that we saw earlier on as well, but it is a very, very important observation. This is Article 14 of the European Convention, which says right to a fair trial. Everyone has a right to a fair trial. Conclusion, Casey Baker. According to Baker, the Strasbourg organs have said that the right to a fair trial does not apply to ordinary proceedings for the determination of tax liability. To say that an individual challenging tax does not have a right to a fair trial sounds ridiculous. The conclusion follows from the autonomous convention meaning. Autonomous convention meaning. The partly because it sounds so ridiculous, the European Court reconsidered its position on this point in the case of Ferrazini versus Italy. So it the fact that someone had to even write that people have a right to a fair trial, it sounded ridiculous. So the importance of this matter was increased. In this case, Grand Chamber of the European Court reviewed the jurisprudence. It is understood that Ferrazini was one of the 2000 Italian delay cases where the tax appeal has 4 November 2001. Taxation and human rights took more than 10 years to come to court. And even in Italy, that is a very long time. The court decided not to change its position and held that in a case concerning a dispute about a tax assessment, the convention does not grant the right to a fair trial. Very interesting. So, although the delay was there, the court still said that the tax assessment will stand. So it did not allow this matter to be brought to court. There are also many cases in which the court has found that serious tax penalties are criminal for Article 6 purposes. Let's look at it. The leading case is Bendenon versus France. It is a case about the French penalty for maneuvers fraudulous. The taxpayer complained about the lack of a fair trial, and the court said that since this was a serious penalty, that taxpayer had all the criminal guarantees. Okay, so the criminal view of the case was upheld in this particular case. There was a similar finding in the AP, MP, and TP versus Switzerland. In Switzerland, if a taxpayer is involved in tax evasion, there is a maximum 400% penalty. The court said that this was clearly criminal. So, the traditional view that tax related matters are only civil, these are all examples of where the court has, accepted the view that tax related penalties, tax related matters have a criminal aspect as well. In JJ versus Netherlands, there was a 100% maximum penalty, and this was deemed as criminal. A recent UK case, King versus Walden, HM, Her Majesty's Inspector of Cases, said the same thing. The conclusion is that substantial tax penalties for negligent or fraudulent submission of tax returns are regarded as criminal, and all the criminal protections apply. There is an important right to the presumption of innocence. The onus falls on the tax authority. Now, this is a key point for us to remember. The onus falls on the tax authority wherever there is a serious penalty to prove the fact. Innocent until proven guilty. So, lesson summary. The lesson from these cases in Article 6 and 14 are that both articles are unlikely to be available to resolve ordinary tax disputes which a UAE company has. So now has with a foreign country, but where the company is faced with a proportionally large penalty in relation to tax, the penalty becomes a criminal matter, and as such, the articles may well apply. As a result of this knowledge, you should be able to determine if provisions for tax reflecting unresolved tax disputes and penalties claimed by the company are likely to be resolved by the Human Rights Convention are valid. Now, this was UAE, the previous lesson was UAE outbound claims, meaning this where UAE investor companies have made their investment in foreign countries, and there were various matters, particularly with an emphasis on tax matters. What kind of protection will be available? Because the criminal law also provides certain protections and rights to the defendant. So, but the traditional view was that such protection and rights might not be available because this is a civil matter. But we have seen so many examples in just now that in many cases, the view taken by court was that such tax penalties and were a matter of criminal aspect of law. UAE inbound claim. Now we're looking at the other side, people investing in UAE. Firstly, it is evident that the European Human Rights Convention is not relevant in the UAE, as the UAE is not a signatory to the convention. And secondly, it is also relevant that the UAE has not signed the international covenant on civil and protection rights. So interestingly, both the European Human Rights Convention as well as ICCPR, UAE is not a signatory of to both of these. In September 2022, it is not possible to argue against a UAE tax assessment or penalty under the two main human rights conventions. This is currently the position, notwithstanding the UAE having signed certain specific UN human rights conventions, including but not limited to the Convention on the Elimination of All Forms of Discrimination Against Women, the International Convention on the Elimination of All Forms of Racial Discrimination, and the Convention on the Rights of the Child. So various conventions are there, but it seems that until the writing of this article, and to my knowledge, even to date, if penalties are imposed by the federal tax authorities, you cannot, prepare your defenses under the human rights conventions or other conventions which have been named here. UAE Constitution. So another interesting aspect, in the absence of a UAE business having the right to rely on the international human rights conventions to resolve a tax dispute with the UAE, the question arises as to whether a taxpayer has rights under the United Arab Emirates Constitution of 1971, issued on 18 July 1971, which it could pursue to resolve a tax dispute with the UAE. So I believe there might be other laws like civil procedures law or the penal code, but for the time being, I mean, in this course, what we are looking at is the highest level of law that any country has, which is the constitution. Now, we are resorting to the UAE constitution to see whether there is a human right aspect to tax disputes, particularly of relevance to this question would be part 2 of the Constitution, which describes the fundamental social and economic basis of the Federation, and part 3, which describes the public freedom, rights, and duties. So, if you, by the way, just to let you know, UAE Constitution is freely downloadable from Google. You guys can quickly search and download the UAE Constitution. It is an important document for auditors as well as tax practitioners to refer to. So part 2 and part 3 of the UAE Constitution would be relevant. So what we are going to quickly look at is what those parts are. For the purposes of this inquiry, the relevant articles are 21, 28, and 39. Let us look at it. Article 29 provides that private property shall be protected. Restrictions relating thereto shall be laid down by law. No one shall be deprived of his property except in circumstances dictated by public benefit in accordance with the provisions of the law and in consideration of just compensation. So again, compensation angle has been mentioned, public benefit angle has been mentioned, which are the common features that we studied earlier on in case of expropriation of foreign assets. That was Article 21 of the UAE Constitution. Now we're looking at Article 28 of the UAE Constitution, which provides that the penalty is personal. An accused shall be presumed innocent until proven guilty in a legal and fair trial. The accused shall have the right to appoint the person who has the capacity to defend him during the trial. The law shall prescribe the cases in which the presence of a counsel for the defense is must. So in short, if there is a penalty or if there is a case on a person, the person has full rights granted to him under the UAE constitution, and he can appoint his counsel. It should be a fair trial and all that. Article 39 provides that public confiscation of property is prohibited. The sanction of private confiscation shall not be enforced except by court order and in the instances provided in the law. So if you look at it, the Article 21 and 39 have some common features where again 21 also says the provided private property shall be protected, restrictions relating thereto shall be laid down in the law. But here this is public confiscation of property is prohibited. So let's go forward. Presently, it is unknown whether the UAE Supreme Court would uphold a claim under the Constitution to resolve a UAE tax dispute, but were the Supreme Court to be persuaded to adopt the precedents set by the European courts, then it may well do so, but only to deal with matters of substantial penalties or whether a taxpayer had been granted a fair trial on a tax matter in the lower courts. So we haven't reached that point yet from the corporate tax law perspective. From the UAE VAT law perspective, because VAT has been there since 2018, so it is quite possible that some matters might have reached the Supreme Court of UAE. So I'm not aware of those case laws, but we can always do our secondary data research. Lesson summary: the outcome from the section is that a UAE tax dispute would not be able to be resolved by a taxpayer applying under the EU or UN conventions, because the UAE is not a signatory to either of the conventions. So it should be remembered that neither EU, European Union, nor United Nations, both human rights conventions, UAE has not signed. It is unclear at this juncture whether the UAE Supreme Court would uphold a claim to resolve a tax dispute under one of the articles in the UAE Constitution. Using this knowledge, you can test whether provisions for tax reflecting unresolved tax disputes and penalties claimed by the company to be likely resolved by the Human Rights Convention or the UAE Constitution would be valid claims. Because this, I mean, naturally, from a corporate tax perspective, still things are starting up. The first deadline is approaching in December, on December 31st. So if at all there are any corporate tax related disputes or claims or cases filed, it will happen after 31st December 2024. Great. So guys, we have reached the knowledge check, I believe. Let us read and try to answer. Select the correct answer. The OECD G20 BEPS project making dispute resolution mechanisms more effective, action plan number 14. So this is centered on the mutual administration procedures. Is it mutual administration procedure or mutual assistance procedure? This grew out of the OECD's mutual, manual on effective mutual agreement procedures, manual on efficient mutual agreement policies, manual on effective mutual agreement resolutions. What would be the answer? I think this is the answer. Shall we try?
Effective mutual agreements procedure.
Okay. True or false? The UAE subscribes to the mutual assistance or administrative procedures process because a MAP article is included in most of its bilateral DTCs. True or false?
Oh, true.
True. Okay. Next question is again, the arbitration part of the multilateral instrument, which is part 6, provides for a state to choose to apply the part and to notify the depository accordingly. Part 6 does not apply when the two contracting jurisdictions have made the notification. Choose the correct answer. Is this right to say part 6 does not apply when the two contracting jurisdictions have made the notification?
False.
I think it would be false. Let's see. Because that part 6 is on arbitration. It's not only for notification purposes, but let's read. In relation to the UAE's position on arbitration, the background is that the arbitration part of the MLI provides for a state to choose to apply the part and to notify the depository accordingly. Part 6 only applies when the two contracting jurisdictions have made the notification. Okay. Choose all that apply and when select submit. One alternative means of tax dispute resolution is arbitration. Arbitration is offered as an option in the following instance. Okay, which instances? Arbitration is an option offered by the OECD and UN in their model DTCs. Is it correct? Yes, in both
Yes.
it is
Yes.
arbitration is an option offered by the OECD and UN in an investment treaty for resolving tax disputes?
No.
No? Okay. Arbitration is an option offered in an investment treaty for resolving uh, investor-state disputes, including tax disputes.
No.
I think this is correct. Arbitration is an option offered in an investment treaty for resolving investor-state dispute. If I think this is correct. Let's again revisit the second one. Arbitration is an option offered by the OECD and UN in an investment treaty for resolving tax disputes. I
They
don't think
both
this,
offer,
huh,
but not in the investment treaty.
not in the investment treaty. Okay,
Yes.
let's do that. Arbitration is an option offered in an investment treaty for resolving uh, investor slash state disputes, including. Okay, let's submit. We'll see. Arbitration is an
Yeah,
option.
you were right. First and last one. Yeah.
Yeah. Select the correct answers. In the lesson that discusses models of double tax conventions and the UN, which article has the UN adopted with wording that is similar to that adopted by the OECD, except for three differences? Three differences were there. Which article? Okay, let's look at it. In the lesson that discusses models of double tax convention and the UN, which article has the UN adopted with wording that is similar to that adopted by OECD,
That
except
was of arbitration, right? It
mm,
was for 2 years, and UN allowed 3 years after 3 years.
yeah, and the UN does not give the right to the taxpayer. Yeah,
Yes,
yeah.
yes. UA
Hmm.
give the right to the taxpayer.
Hmm.
And there was a third one also. That was what was that?
I have also forgotten which one was that.
Yeah, that one.
The
Yeah, there was three.
three points were there.
Yeah.
Uh, this is a test of memory, so I mean, as long as we remember what was there, that should suffice. Now I think what was that? Okay, I think it was Article 26, Mutual Administration Procedures, right? I think this is the one. Let's check. Uh, 25. Yes, sorry. It was not 26, it was 25 for map.
Yeah, and the third point was, I think it was binding on two states. UN says it is binding on two states,
Ah,
contracting states.
yes, and OECD it was not, correct.
Yes.
So let us look at the sixth point. To whom did the UAE Ministry of Finance send a listing of reservations and notifications after they signed the MLI on the 1st September 2019? That should be an easier one.
This one, multilateral instrument MLI depository.
Yes, I repeatedly mentioned the name of
Yes.
depository.
Yes.
So this is the one. Okay, let's look at the point number 7. BIT, bilateral investment treaty, is an agreement made between two companies containing reciprocal undertakings for the promotion and protection of private investment made by representatives of the signatories in each company, uh, in each other's companies. Oh, in each other's companies. Choose the correct.
Country.
Huh? In each other's company.
That is
Choose.
false.
That is
Otherwise,
false.
it was correct.
Everything was correct, but in the end they mentioned companies instead of, you know, this is a bilateral investment treaty. It is signed between two governments, not companies. It is not. Okay.
Yes.
Let's look at that. The UAE has a wide network of bits and tips, as would be expected for a country making itself as a hub for global investment. Choose the correct answer. Yeah, I mean,
True.
that's true. That's an easier one. Select the correct answer. In relation to the rights which a UAE entity can rely on to resolve a tax dispute with a foreign government, what is it? In relation to rights which a UAE entity can rely on to resolve a tax dispute with a foreign government, they generally fall under various human rights convention, with the two most relevant being European Convention on Human Rights. That's what we studied, I believe, right? And then there was another one, right? ICCPR.
Yes.
So these are the two conventions. Okay. Then we come to the 10th one. A UAE tax dispute would not be able to be resolved by a taxpayer applying under the EU or UN convention because the UAE is not a signatory to either of the conventions. We just read
True.
UAE has not signed the EU Convention on Human Rights and also the ICCPR. So, I mean,
Yes.
under these two conventions, a taxpayer cannot resolve, right?
Yes.
So, let's look at the answer. Okay, so we barely passed. But anyways,
Yes.
it was an interesting lesson actually, very important, and the timing of this lesson was very right actually. Why? Because after 31st December 2024, probably the tax practitioners are going to encounter quite a few things on this. So let us look at the summary of what we have done. By completing this module, you can now describe how the OECD's mutual assistance procedures will assist a taxpayer to resolve a tax dispute. Discuss the role of arbitration to resolve tax dispute. Define the rights of a UAE investor under the Human Rights Convention. Identify whether an inbound UAE investor may have rights under a human rights convention to sue the UAE government over a tax dispute. And actually, lastly, identify why a UAE tax dispute would not be able to be resolved by a taxpayer applying under the EU or UN convention. So great, that's about it. Thank you very much for joining the class, and inshallah we are going to meet on next Saturday. And those who are here, I would again request, guys, please join the class at 10 so that we can finish in time. Uh, Gradually, I think there's one more module left before this was, I think, 5 or what? I think from module number 7 we are going to start the corporate tax related module, inshallah. Thank you, guys. Thank you for joining today. Inshallah, meet you on the next Saturday. Take care.
Thank you. Inshallah. Take care. Bye bye.